Hello, I'm JP Powers, Chief Investment Officer at RWA Wealth Partners. Thanks for joining me for this month's market update. August began with a hint of the market's usual late summer unease, but resilient earnings, moderating inflation trends, and expectations for Fed policy shifts have all helped restore confidence. As we head toward the Fed's annual Jackson Hole gathering, the tone is far more constructive than it was just a few weeks ago. Let's break it down, starting with some good news. We're at the tail end of second quarter earnings season, and the results have been nothing short of stellar. Expectations coming in were clouded by the on-again, off-again tariff policies, but the results speak for themselves. With over 90% of the S&P 500 now reported, the average sales growth came in at about 6%, with earnings growth above 11%, both exceeding expectations. Again, with so much turmoil in the second quarter, analysts perhaps struggled to figure out where to place expectations. But that isn't necessarily a new phenomenon. This chart is showing the spread between earnings growth estimates as we're entering earnings season and then the actual results delivered by companies. Looking at the most recent quarter all the way to the right, you see actual earnings for the S&P exceeded expectations by almost 7%. And that has been the case for 3 straight quarters. Now, companies are known to lowball their guidance, hoping to set the bar low and make it a little easier on themselves as they try to beat the market's expectations. But you can see how this trend of outperforming by such a margin really stands out over the last decade. A lot of this has to do with the new administration coming into the White House and the market trying to understand what the impact to company bottom lines would be. And the concern going forward is whether expectations are now creeping up as a result, and whether this strong performance can continue, especially now that we've cleared some of the unknowns around trade policies in Washington, at least for the moment. News out of Washington impacting markets is going to be a big theme today. But for now, let's focus on the labor front, where one of the economy's most reliable tailwinds started to show some cracks in July. The July jobs report was one of the most disappointing in recent memory, with just 73,000 payrolls added. And prior months were revised lower by a combined 258,000 jobs. The unemployment rate ticked up to a still quite low 4.2%, but this marked the weakest 3-month average job gain since 2020. The president called the validity of the report into question and almost immediately fired the head of the Bureau of Labor Statistics. His new pick, E.J. Antoni, floated the idea of suspending the monthly report in favor of a quarterly release before backing away from those comments. Now, I can't underscore enough how important these data releases are to market participants, and particularly so as we approach a potential policy shift at the Federal Reserve. More on that in a moment. For now, let's turn to inflation. Data this week showed the July Consumer Price Index rose 2.7% year over year, with core inflation, which excludes the volatile food and energy segments, still running above target at roughly 3.1%. You can see here the tremendous progress that's been made over the last few years following that COVID-induced spike, but the recent progress has slowed, and the results have been more of a mixed bag. Still, while tariffs have been felt in certain categories, the immediate pass-through to consumer prices has been modest, partly because consumers may be trading down and businesses are still cautious about price hikes. That said, tariffs remain a potential source of inflationary pressure in the months ahead. And with that uncertainty across both inflation and the labor market, we turn to the Fed, who has a tough job ahead of them, balancing a dual mandate impacted by both of these economic measures. But with inflation still within sight of their 2% target, and now the labor market showing some slippage, markets are pricing a 90% plus probability of a September rate cut. So that should be good news, right? If the Fed cuts rates, that should stimulate the economy, and markets should cheer the news. Well, history shows the equity response depends heavily on why the Fed is cutting rates. When cuts come as mid-cycle adjustments, with growth still intact, then forward returns can be positive. But when cuts are reactive to an oncoming slowdown, the results are often negative over the short term, and we've seen that several times in the last 25 years. The lesson here being to watch the economic backdrop as closely as the policy shift itself. So, while the committee doesn't officially meet until September, we expect the action to pick up later this month as the Fed convenes at Jackson Hole. This is often a venue for the Fed chair to announce material changes to market participants, and we expect that'll be the case again this time around. In his remarks, Chair Powell needs to balance evidence of a softer jobs market with inflation still running above target, and he'll have to address the uncertainty around trade policy impacts as well. All this while looking over his shoulder for an impending announcement of his replacement by the president. While Powell's term runs until May 2026, investors are already starting to consider succession scenarios, which could bring even more politics into an institution that prides itself on its independence. For the time being, the focus remains squarely on whether the Fed signals a September rate cut, but that turmoil at the Fed will surely be a storyline to watch in the months ahead. So to summarize, earnings have been and continue to be a real bright spot. Inflation remains manageable but unresolved, and that, combined with labor market weakness, has really increased the likelihood of Fed action next month. For investors, this is a great moment to reassess your positioning at a time where markets are feeling very confident, and much different from the cloud that hung over investors during that April sell-off just a few months ago. If there are material changes to be made to your portfolio, now is the time to consider them. I'm JP Powers, Chief Investment Officer at RWA. Thanks for watching. We'll see you next month.